Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover several questions from Chapter 2, the deduction for qualified business income for non-corporate taxpayers. So we'll jump right into this first question. It's asking, from a tax standpoint, Art should initially consider blank. This would allow him to blank. Art, an executive with Azure Corporation, plans to start a part-time business selling products on the internet. He will devote about 15 hours each week to running the business. Art's salary from Azure places him in the 35% tax bracket. He projects substantial losses from the new business in each of the first 3 years and expects sizable profits thereafter. Art plans to leave the profits in the business for several years, sell the business, and then retire. So it's asking us to complete the sentence, which outlines the type of entity that Art's business should be. So one key thing to keep in mind is that businesses, they can be conducted in a number of different forms. We have what's called sole proprietorship, where it's essentially one person, the business is unincorporated. What that simply means is that the individual can just wake up one morning and decide, hey, you know what? I want to start a business. There's no formality to a sole proprietorship. We also have what's called partnerships, fairly similar to a sole proprietor. The key difference is that it's two or more persons. They come together, and much like a sole proprietorship, there's no formality. There's no paperwork that needs to be filed. Then we have what's called trusts and estates. We have S corporations. We have C corporations. We have LLCs. So whenever an individual decides they want to start a business, one of the first things they need to do is to determine what is going to be the form of the business, the structure of the business, because for federal income tax purposes, the distinctions between these forms of businesses, they have a significant impact, right? So based on this situation for Art, it would make the most sense for him to operate as a sole proprietorship or a single member LLC. Reason being is because we see that in the first few years, he's projecting that he's going to have a loss. And one of the benefits of having this sole proprietorship or having a single member LLC is that when you have a business and you have business losses, that loss can offset your other earned income. Here is saying to incorporate the business. So this, decision ultimately is, okay, well, should he, form a C corporation, or should he operate as a sole proprietor or a single member? So with the C corporation, it's a totally separate entity. So in the US tax system, there are two tax-paying entities, individuals as well as corporations. And then there's what's called pass-through entities, which are S corporations, are partnerships, LLCs, etc. It passes through either to the individual or the corporation, which are the tax-paying entities. So for C corporations, the losses, if Art decided to structure the business as a C corporation, he would not be able to get the benefit of the losses on his personal tax return. Hence, the losses would simply carry forward. So therefore, from a tax standpoint, Art should initially consider operating as a sole proprietorship or a single member LLC. This would allow him to deduct the losses against other incomes is correct, but you always want to go through all of the answers. Carry over the losses to future higher taxable years. So in the event that he chose to structure the business as a C corporation, this would be the answer. He wouldn't lose the loss. He just wouldn't get the benefit in the current year. So it would carry forward. Suspend the losses until he can use them. No, right? So the correct answer is operate as a sole proprietorship or as a single member LLC. This would allow him to deduct the losses against other income. This brings us to our next question. Why did Congress decide to provide a deduction for qualified business income? So there was a very big change, very big tax reform in 2017. The Tax Cuts and Jobs Act is often referred to by its acronym TCJA. And the goal was to lower the federal income tax rate for C corporations. However, one of the issues is that not a lot of businesses are structured as a C corporation, right? Most businesses, they operate as sole proprietorships, partnerships, S corporations, and not C corporations, right? There are some C corporations, but the majority of business farms, as mentioned, sole proprietorships, partnerships, and S corporations. So these non-C corporation entities, as mentioned earlier, these are considered pass-through entities. Individuals and corporations are our tax-paying entities, and our S corporations, our LLCs, our partnerships, they are essentially pass-through entities. So considering that, Congress, they decided to, allow this special deduction. This QBI stands for qualified business income deduction. So QBID, so some people call it QBID, QBI, same thing. So what this essentially did is that it provided a significant reduction in corporate tax rates. All corporations were taxed at a flat 21%, and qualified businesses get to claim a 20% deduction. So why did Congress decide to provide a deduction for qualified business income? To provide C corporations with a deduction for pass-through income items? No, that's incorrect. To provide a tax cut for owners of pass-through entities? All right, that sounds about right. To encourage C corporations to earn qualified business income for shareholders? That's incorrect. Lastly, to provide a tax cut to C corporations that qualified as a small business? No. Again, the C corporation rate decreased to 21%, and the goal was for there to be a reduction of the federal income tax rates for C corporations. But again, not all business entities are formed as a C corporation. Hence, Congress passed the qualified business income deduction to provide a tax cut for owners of pass-through entities. So here it asks a bit more about the QBI deduction. So it states, complete the following statements regarding the general rules for the QBI deduction and how it is computed. So at the very surface level, there's a few key things that you must keep in mind when it relates to the QBI. I mean, we live in this day and age where you input information into the tax software, and the tax software automatically, calculates the amount of deduction. But it's very important to understand the nuance behind it, because technology is not always correct. And what about if a client has a question? You want to be able to explain it to the client so that way they understand. So here we'll look at some of the key concepts as it relates to the QBI deduction. So at its most basic level, Section 199A, which governs the QBI deduction, it permits an individual to deduct 20% of the qualified business income generated through a sole proprietorship, a partnership, or an S corporation. And just keep in mind, we'll see here, it doesn't say LLC, but if you are a single member LLC, for tax purposes, you're treated as a sole proprietorship. And if you are a multi-member LLC, for tax purposes, you're treated as a partnership. So just keep that in mind. So as will quickly become apparent, Section 199A uses the word qualified to modify many phrases. All right, but to begin with the basics, as it says here, in general, the qualified deduction for qualified business income is the lesser of 20% of qualified business income or 20% of the modified taxable income. So based on this information, there's a lot of nuances. We'll look at a problem a little later and we'll see that there's some limitations, there's some caveats, there's some things that we need to consider. But at the very minimum, the basic, the deductions, the lesser of 20% of QBI or 20% of modified taxable income. So based on this, we can, answer some of these questions. So the QBI deduction, is it available to all taxpayers, corporate taxpayers, or non-corporate taxpayers? So it's definitely not all. This does not apply to individuals that do not have a business. So all is not the answer. This doesn't apply to corporate taxpayers, again, corporate taxpayers, their tax rate was reduced to 21%, but not all business forms are corporations. Hence, the QBI deduction is available to non-corporate taxpayers. It applies to the qualified business income generated through all business entities? No. C and S corporations? No. A sole proprietorship, partnership, or an S corporation. Again, the goal for the tax reform in 2017 was to lower the federal income tax rate for C corporations, but not all businesses operate as a C corporation. So that is why all business entities are incorrect. C corporation and S corporations are incorrect. The correct answer is a sole proprietorship, a partnership, or an S corporation. So in general, as we just read, at the very basic level, the deduction for qualified business income is the higher, no, the lesser of 20% of qualified business income or 20% of modified taxable income. So lastly, it says the QBI deduction is a deduction blank AGI. Further, the deduction is available blank, right? So if we go back to the information, effectively, the QBI deduction is a from AGI deduction. So what that simply means is it's an above the line deduction. This is before we consider standard deduction or itemized deductions. So QBI deduction is a from AGI deduction. It's the last deduction taken in determining taxable income. Further, the deduction is available whether a taxpayer uses the standard deduction or itemizes deduction. So keep in mind, the QBI deduction is not a for AGI deduction, it's a from AGI deduction. The deduction is available for. Does it matter if they take the standard deduction? No. Does it matter if they claim itemized deductions? No. The key thing is whether the taxpayer uses the standard deduction or the itemized deduction, they are allowed to claim QBI. So in this example, it asks, which of the following taxpayers may claim a deduction for qualified business income? Select yes or no, whichever is applicable. So as we pointed out, the corporate income tax rate was reduced to 21%. With the Tax Cuts and Jobs Act in Congress, they wanted a means to reduce the taxes for businesses that do not operate as C corporations. So here we have some examples. So we want to determine, do they qualify for the QBI or not? Again, it's a sole proprietorship, partnership, S corporation, and those that operate as a single member LLC, which for tax purposes is treated as a sole proprietorship, or a multi-member LLC, which for tax purposes are treated as a partnership. So we have a driver for Uber or Lyft. The answer would be yes. Why? Because those who work for Uber, Lyft, they are considered independent contractors and not employees. Next, we have a veterinarian operating as an S corporation. In addition to veterinary services, revenues are also derived from the sale of pet food and suppliers from the boarding of the animals. Correct answer would be yes. So an individual owner of an S corporation is considered eligible. Just keep in mind there are some nuances behind the type of businesses that the person have. We have what's called specified services, trade, or business. So there are some, nuances as far as if the taxable income exceeds thresholds and things of that nature. But yes, a veterinarian operating as an S corporation is allowed to claim a deduction for QBI. Next, we have a CPA operating as an LLC, taxed as a sole proprietorship. The CPA is single and has taxable income of $150,000. So the answer is yes, the sole proprietor is eligible for a QBI deduction. D is a bit similar. So here we see a CPA operating as an LLC, taxed as a sole proprietorship. The CPA is single and has taxable income of $200,000. So the key distinction between C and D is the income level. So because of the income level, based on D, it will result in a reduction rather, of the QBI deduction. So here we'll look at this information so you all can see. Because again, there are some limitations to keep in mind. So here we see limitations on the QBI deduction. So the basic application of Section 199A, it becomes more complex once a taxpayer reaches certain taxable income thresholds. So these taxable income thresholds are determined without regard to the QBI deduction. So for a married filing joint taxpayer, it's $383,900, and for single or head of household, it's $191,950. Right? So it's something to keep in mind. That's the threshold for 2024, and in 2023 for married filing joint couples, it was 364,200. For a single and head of household, 182,100. So based on this example we see here, the CPA had taxable income of 150,000. It's below the threshold for 2024 of 191,950. However, in example D, we see the taxable income is 200,000, which is above the threshold. Hence, there will be a reduction of QBI. So just something to keep in mind. So yes, they are qualified, but there is a reduction because of the taxable income level. Next, we have a real estate salesperson. The answer is yes. Real estate salesperson is not an employee. Next, we have a self-employed pet sitter, dog walker. If the individual is self-employed rather than an employee, the answer is yes. Next, we have a sole proprietor software developer. Yes, the software developer that operates in his or her own business is considered eligible. Next, we have a taxpayer who is a wage earner. No, unfortunately, any income earned as an employee, it is not eligible for the QBI deduction. Lastly, we have a taxpayer also derives $60,000 of rental income from a duplex she owns. The answer is the rental is likely a trade or a business, therefore it can produce a QBI deduction. So the answer is yes. So now we have an example where we actually need to do some calculating. We need to confirm whether or not, or how much rather, the QBI deduction would be. So here it's asking Megan's QBI deduction is. It states in 2024, Megan, a single taxpayer, has QBI of 136,200 and modified taxable income of 95,340. This is also her taxable income before the QBI deduction. So it's saying, given this information, what is Megan's QBI deduction? So we know that at the very, basic level, QBI deduction is the lesser of 20% of qualified business income or 20% of the individual's modified taxable income. So based on this information, we see here QBI is 136,200. We multiply it by 20%. All right. And then next, the modified taxable income. So I'll just write TI for taxable income. Which in this case is 95,000. That's supposed to be a dollar sign. 95,340. All right, multiply by 20%. Oh, that looks a little crazy. All right, but you guys know what I mean, 20%. All right, so we'll compare these numbers. So we have 136,200 multiplied by 20%, which would give us 27,240 versus 95,000 95,340 multiplied by 20%, which gives us 19,068. All right, so if we compare the two, 27,240 versus 19,068, the lesser of the two is 19,068. Hence, we take 20% of the taxable income. So again, to go over it quickly, in order for us to determine the QBI, for the most part, we see here the taxable income is 95,340. This is far below the limitations. She's single and her taxable income is less than the 191,950. So therefore, I'll clear these drawings. So therefore, we don't need to worry about any of the limitations. So at the very surface level, again, it's 20% of the qualified business income, which was that 27,040 versus 20% of the modified taxable income, which is this 19,068. So now for this example, it's asking what is that qualified business income deduction? So it says that a single taxpayer has taxable income before the QBI deduction of 189,000. That a CPA operates an accounting practice as a single member LLC, which he reports as a sole proprietorship. During 2024, his proprietorship generates qualified business income of 151,200, W-2 wages of 113,400, and 10,400 of qualified property. So it says assume the QBI amount is net of the self-employment tax deduction. If required, round any division 2 decimal places and use the rounded amount in any future computations. Round the final answer to the nearest dollar. All right, so in this example, there's a lot going on, right? There's a lot that we need to consider with that. So I'm gonna actually pull up this Excel spreadsheet and we'll work through it side by side. All right, so as we know, in general, the deduction for qualified business income is the lesser of 20% of qualified business income or 20% of modified taxable income. However, there's 3 limitations on the QBI deduction, right? So an overall limitation based on modified taxable income. Get this in the screen. Make this a little. All right, so there are 3 limitations on the QBI deduction: an overall limitation based on modified taxable income, another that applies to high income taxpayers, and one that applies to certain types of certain businesses. And then there's a second and third limitation that's applicable when taxable income before the QBI deduction for married filing joint taxpayers exceeds 383,900. And for a single and head of household taxpayers, 191,500. So for that situation, we also, need to factor in a few more things. So due to the limitations mentioned above, the basic application of 199A, it can become complex. And again, computer softwares, they essentially, do this for us. They do the math, they consider the limitations, but again, you want to be able to understand the nuances between what's done. So once the thresholds are met, Here it say the QBI deduction is capped based on a percentage of the W-2 wages paid by the business or based on the smaller percentage of wages paid by the business and a percentage of the cost of its depreciable property. The QBI deduction generally it's not available for income earned from specified service businesses. So this includes doctors, dentists, lawyers, accountants, consultants, etc. So in this case, W-2 wages were issued. So therefore, that's something that we need to consider. So for the W-2 wages capital investment limitation, it limits the 20% QBI deduction to the greater of 50% of the W-2 wages paid by the qualified trade or business. And in this case, it tells us that there were W-2 wages of 113,400. So we need to factor these things. So in this example, we see that he doesn't meet the threshold. So therefore, we let me see, his QBI deduction, his taxable income is the 189,000. So therefore, it is the lesser of the two, the 189,000 versus the 151,200. So here we have 189,000 multiplied by 20%, which gives us 37,800. Versus 151,200 by 20%, which gives us 30,240. So based on this information, again, because FAD's taxable income before the QBI deduction is less than, let me make sure this is 2024, perfect. So because it is less than, in such case, we take the lesser of the two. We know that the qualified business income of 151,200 is less than the deduction, or less than rather the taxable income before the QBI deduction. So therefore, the 20% QBI deduction is 30,240. All right, this brings us to our next question. And we have two questions we need to answer. It says Ellie and Yeeling are equal owners in Otter Enterprises, a calendar year business. During the current year, Otter Enterprises has $320,000 of gross income and $210,000 of operating expenses. In addition, Otter has a long-term capital gain of $15,000 and makes distributions to Ellie and Yeeling of $25,000 each. What is the impact of this information on the taxable income of Otter if it's a partnership, if it's an S corporation, and if it's a C corporation? So in the event that it's a partnership, again, a partnership is a pass-through entity. So the income, again, it passes through to the individual partners. So if Otter is a partnership, it will report net ordinary income of, here we see, so it has 320,000 of gross income. So we do the math. 320,000 of gross income, 210,000 of operating expenses. So therefore, they will have business income of 110,000 on its Form 1065. Both Ellie and Yeeling will receive a Schedule P1. No. A Schedule K1. Yeah, but we'll look at the answer. It's a Schedule M3. No, and no schedule. So the correct answer is a Schedule K1. All right, and just to ensure that you understand the difference, All right. So Schedule P1, that is not, in the tax law. But we do have what's called a Schedule M3. So the M3, that is essentially the form that reports, it's asking questions about the partnership's financial statements, and it basically helps to reconcile. So it kind of like gives the IRS additional information about tax return calculations, because if there's any book to tax differences, this M3 kind of helps to reconcile the two. Schedule K1, on the other hand, this essentially reports the individual partners, their income, their deductions, their gains and losses and things of that nature. So they would receive a Schedule K1, and they will each report a profit of, again, it's 50-50. So therefore, we would divide the business income by 50%. Oh, wait, sorry. Divide it by 2 or multiply by 50%. So multiply by 50%. Each person would report a net profit of 55,000, and separately in long-term capital gain of 7,500. How do we get that? It shows us that Otter has a capital gain of 15,000. They are 50% partners, so 15,000 multiplied by 50%. They both report 7,500. Next, it says the 20%, 15%, and 0% preferential tax rate applies to. So keep in mind, this preferential capital gains rate, this only applies to long-term capital gains. The partner's distributions, will it have an impact on the taxable income? It does not affect Otter's taxable income, and they are not reported as income by Elliott Yeeling. Lastly, the partner's basis in the partnership, is it increased or is it decreased? Is it affected or not affected by distributions? The basis in the partnership, it is decreased. It's affected by the distribution. So that's if they are a partnership. Next for B, we have if Otter's an S corporation. So if Otter's an S corporation, they'll report ordinary business income or loss of 110,000, same thing as basic math, 320,000 of gross income and 210,000 of operating expenses, which gives us income of 110,000. But instead of Form 1065, as an S corporation, it's reported on Form 1120S. Next, we have Ellie and Young. What will they receive? They also receive a Schedule K1. One of the key differences, however, is that for a partnership, they'll receive Form 1065 K1, and for an S corporation, they receive Form 1120S K1, right? But for the most part, it's fairly similar. For the most part, it's fairly similar. They report the income, the deductions, the gains and the losses for the shareholder. All right. And just a bit of a nuance, for partnerships, the owners are called partners, and for S corporations, the owners are called shareholders, right? So just different verbiage, same thing at the very surface level. And it says they each will report a net profit of, same thing, 55,000. They are 50% owners. So 50-50. And separately stated long-term capital gain of 7,500. So next it says the 2015 0% preferential tax rate applies to, again, this long-term capital gains rate, it only applies to long-term capital gains for Ellie and Yeelan. The corporate distributions do not affect Otter's taxable income, and they are not reported as income by Ellie and Yeeling. The shareholders' basis in the corporation is decreased by the distribution. So you might be thinking, wait, the answer for partnership and for S corporation is totally the same. Correct, right? But one key thing to keep in mind is that with partnerships, let's say they're 50-50 owners, we can decide, hey, Ellie, she works in the business more than Yeeling. So instead of splitting it 50-50, the profit could have been split 70-40, right? Ellie received $70,000 because she worked in the business more, and Yeeling received 40,000. So that could be an option under a partnership. In an S corporation, however, profits can only be shared based on the ownership in a company. So that's one of the nuances. That's something, that you want to keep in mind. If you're advising your clients to set up an S corporation, they need to understand that distributions of profits need to be in proportion to the shareholder ownership, right? So that's a big nuance between a partnership and an S corporation. All right, this brings us to the last one. C, if Otter is a C corporation, it will report. All right, so with an S corporation, things are a little different, right? For a partnership and S corporation, things are separately stated, but not for a corporation. So for the corporation, we have $320,000 of gross income. And then we also have to factor in the expenses of 210,000, which gives us 110,000. But we also factor in our $15,000 long-term capital gain. So as a C corporation, we will report net ordinary business income of $125,000 on Form 1120. Ellie and Yi Ling, they won't receive anything from the corporation. Again, a corporation is a separate tax-paying entity. There are two tax-paying entities in the US. The first are individuals, the second are corporations. So each will report a net profit of 0, separately stated long-term capital gain of 0, right? And then they would receive dividend income of $25,000, because it lets us know here they make distributions of $25,000 each. So in an S corporation, in a partnership, the $25,000 distribution would reduce their basis. But as a C corporation, the $25,000 would be treated as a dividend. And the corporation's distribution, it will not affect Otter's taxable income. And the distribution, it would be reported as income by Ellie and Yeeling. They would receive a Form 1099 DIV from the corporation, and they would report it with their individual tax return. All right. So here we have this next question, and it is asking us to calculate the QBI deduction. All right, so it's asking, what is Ashley's QBI deduction for 2024? It says, Ashley, a single taxpayer, is the owner of ABC LLC. The LLC, which reports as a sole proprietorship, generates QBI of $900,000 and is not a specified services business. ABC paid total wages of $300,000, and the total unadjusted basis of property held by ABC is $30,000. Ashley's taxable income before the QBI deduction is $740,000. This is also her modified taxable income. So hold up. Now we need to look at the rules, because as we can see here, we know that in general, the deduction for qualified business income is the lesser of 20% of qualified business income or 20% of modified taxable income. However, there are 3 limitations, right? And the second and third limitation applies when the taxable income before QBI deduction exceeds $383,900 for married filing joint, or $191,950 for single and head of household. Here we see Ashley's taxable income before the QBI deduction is $740,000. So based on this, we need to factor in the second and third limitation. So considering this, and let's go through these steps here. All right, and what we can do to make it easier, we'll put all the information in. All right, let's just do this and we'll remerge it. Okay. All right, so we're gonna merge this. All right, so there's a few things we're gonna need to factor in again because Ashley's income is way above the threshold. So one of the first things we need to figure out is one, so you do 20% qualified business income. I'll actually copy these over. So as we see, qualified business income, in this case is 900,000 multiplied by the 20%. That will give us 180. All right, so that will give us 180. All right, so that will give us 180. But again, because of the income limitation, we need to factor in these things here. So due to the limitations mentioned above, the basic application of 199A, again, it becomes more complex once the taxpayer reaches certain taxable income thresholds. So because the threshold has been far reached for Ashley, we need to factor in these two independent limitations. The QBI deduction is capped based on a percentage of W-2 wages paid by the business. And the QBI deduction, again, it's not available for specified service businesses, but we don't need to factor that in. So here's what we need to do. Factor in these 50% of W-2 wages or 25% of wages plus 2.5% of the taxpayer share of unadjusted basis. So to make it easier, I'll do it here. 50% of the W-2 wages. So based on a problem, it lets us know that the W-2 wages were $300,000. So equal 300,000 multiplied by 50%. That gives us 150,000. Versus 25% of W-2 wages. So 300,000 times 25%, which would give us 75,000. And then we would also have to add 2.5% of the unadjusted basis of qualified property. So the problem lets us know here that they have unadjusted basis of the property held by 30,000. So 30,000 multiplied by 0.25%. So therefore, we add that up again. It becomes a bit more complex once there's more nuance. So it'll be the 75,000 plus 750. So we have these numbers we're factoring. We're factoring in the 150,000, which is 50% of the W-2 wages that's paid by the firm. And as we see here, it lets us know W-2 wages were 300,000. So we multiplied that by 50%. Next limitation is 25% of W-2 wages, and that's how we calculated the 75,000. 300,000 multiplied by 25% paid plus 2.5% of the taxpayer's share of unadjusted basis. And it lets us know here that the total unadjusted basis of property is 30,000. So we multiplied the 30,000 by 2.5%, and that is how we got 750. So we added the two, 75,000 plus 750, and that is how we calculated the 750. So these are the numbers we're considering so far. 180,000, which is 20% of qualified business income. 150,000, which is 50% of the W-2 wages, and 75,750, which represents 25% of the W-2 wages plus 2.5% of the unadjusted basis of the assets, right? So it's the lesser of the 180,000, but it can also be no more than 20% of the modified taxable income. So again, there's a lot of nuance to consider. So the taxable income is 740,000. We multiply that by 20%. So these are the numbers that we need to factor in. So 20% of the qualified business income, right? But no more than the greater of the 150,000 or the 75,750. And then from there, it cannot be greater than 20% of the modified taxable income. So with this problem, again, there's a lot that's going on. At the very first surface level, and I'll go over it quickly, Ashley, she's a single taxpayer, generated QBI income of 900,000. Her taxable income before the QBI deduction was 740,000. So because her income was above the threshold, which is 191,950, because she met this threshold, there are some independent limitations that apply. And that is why we had to factor in the W-2 wages capital investment limitation. And these things essentially had an impact on the additional computations and the complexity of it. So we needed to factor in 50% of the W-2 wages, and we need to factor in 25% of the W-2 wages paid, plus 2.5% of the unadjusted basis of property. And then at the very least, the QBI deduction cannot be greater than 20% of the qualified taxable income. So based on this, the correct answer is going to be 148,000. So I know that there was a lot going on in that problem. I'm going to upload the spreadsheet so that way you guys can see the calculations and the nuance as it relates to this problem. But again, the key thing, you always want to double check, what is their taxable income? As they are single, as they are married, filing joint, does it exceed the taxable income threshold? Next, we have Kyra, and it's asking, what is Kyra's tentative QBI based on a W-2 wages / capital investment limit, and determine Kyra's allowable QBI deduction. So it says Kyra, a single taxpayer, owns and operates a bakery as a sole proprietorship. The business is not a specified services business. In 2024, the business pays $60,000 of W-2 wages, had $150,000 of qualified property, and generates $200,000 of qualified business income. Kyra also has a part-time job earning $22,800 and receives $3,800 of interest income. Her standard deduction is $14,800. All right, so we have this opportunity to, kind of look at this information again. So we need to determine for Kyra her income. So here for Kyra, we have the business income of $200,000. I'm going to get the calculator. She has the business income of 200,000 plus her wages of 60,000. Oh, wait, nope, sorry. Wages of 22,800. All right, so I'll start from the top. Kyra has qualified business income of 200,000. She has a part-time job where she earns 22,800. And then in addition, she also earned $3,800. Again, 200,000 plus 22,800 plus 3,800. All right, perfect. So 226,600, which represents her adjusted gross income. And then from there, we subtract her standard deduction of 14,600. So therefore, her taxable income before the QBI deduction is 212,000. So I'm going to go over that again quickly. $200,000 of qualified business income, 22,000, and all the information is here, so we know. 200,000 of qualified business income plus 22,800 of part-time earnings plus 3,800 of interest income. That gives us her gross income. We subtract the standard deduction of 14,600. So her taxable income before the QBI deduction is $212,000, right? But we see the issue here is that her taxable income before the QBI deduction, it exceeds $191,950. And because of that, the W-2 wages and the capital investment limit has to be considered. So what is her tentative QBI based on? W-2 wages, capital, and investment limit. So we go back to our Excel. So the fact pattern is a little different, but again, we still need to do the math. We still need to determine, all right, what's 50% of the W-2 wages, etc. So I'll copy over the information. All right, so based on this information, again, the W-2 wages, capital, investment applies. So 20% of the qualified business income, start with that first. The business income was 200,000. We multiply by 20%, so 40,000, but no more than the greater of 50% of the W-2 wages. It lets us know here that they paid 60,000 of W-2 wages. So 60,000 multiplied by 50%, that will be 30,000, or 25% of W-2 wages. So 60,000 multiplied by 25%, which would be 15,000. Plus 2.5% of the unadjusted basis, and it lets us know that they have qualified property of 150,000. So 150,000 multiplied by 2.5%, which is 3,750. So we add the two, 15,000 plus 3,750, which is 18,750. So this is our first limit, 20% of qualified business income, but it cannot be greater than 30,000, which is 50% of the W-2 wages, or 25% of W-2 wages plus 2.5% of the unadjusted basis, which gave us a total of 18,750. And it cannot be more than 20% of the modified taxable income. So therefore, the modified taxable income, which we calculated before, was 212,000 multiplied by 20%. So we need to factor in all of these different numbers. 20% of the qualified business income, but it cannot be greater than 30,000 or 18,750. So initially, Kyra's QBI deduction, it's limited to 30,000. All right, so initially that's what it's limited to. But because her taxable income before the QBI deduction exceeds 191,950, but it's less than 241,950, which is where it starts to phase out. So as we see here, these limitations are fully phased out once taxable income exceeds 493,900 for married filing joint individuals and 241,950. So she doesn't fully phase out. So based on that, that is why there is a reduction. So therefore, first things first, let's answer the first question. What is her tentative QBI deduction? So her tentative QBI deduction would be 30,000, but again, she phases out. So the first thing we need to do is to determine the difference between the 20% QBI deduction amount and the W-2 wages capital investment limit amount. So it will be as follows. All right, so I just started fresh here. So we have the general 20%. I'll make this a little bigger. So we have the general 20% QBI deduction amount, which we know is 40,000. How did we get that? It was a 200,000 of QBI income multiplied by 20%, which gave us the 40,000. And then next we have to subtract the W-2 wages / capital investment limit, right? Based on a problem we know that they paid $60,000 of wages. It's limited to 50%. So 60,000 multiplied by the 50%, which is 30,000. So the excess in this case is the 40,000 minus the 30,000. So there's an excess of 10,000. I'm just going to try to make this a little easier. All right, so this is step one. And again, the reason we're doing this step is because she falls within the range of where the QBI deduction needs to be phased out. All right, so this is step one. Next, we have step two. All right, so for step two, we determine the deduction ratio. So how do we determine that? It's the taxable income before the QBI deduction. So taxable income before QBI deduction minus QBI threshold. All right, so in such case, it's the 212,000 Now I should write in a number so you can see. So 212,000 minus the 191,950. So I want you guys to be able to see the numbers. All right. And that essentially gives us 212 minus 191.50. That gives us 20,050. All right. And then the next thing is that we need to reduce it by, or divide it rather, by 50,000. All right, and why do we reduce it by 50,000? As we see here, the reduction ratio is as follows: taxable income before QBI deduction minus threshold amounts divided by 100,000 for married filing joint or 50,000 for all other taxpayers. So divided by 50,000. So based on this information, the reduction ratio is 20,050 divided by 50,000. So it's 40% in this case. So that's step two. Now we move on to step three. We determine the reduction in the W-2 wages / capital investment All right. And in order for us to do that, we multiply the excess, which in this case is 10,000, by the reduction ratio. And that gives us 4,010. So now for step 4, we determine the final QBI amount. And in order for us to determine the QBI amount, we consider the general QBI deduction. I'm just going to copy these over and make the changes. So the general QBI deduction amount, which is 40,000, less the reduction in the W-2 wages capital investment limit, which we just calculated up above, is 4,010. So therefore, the final QBI deduction amount is 35,990. All right. So again, I know there's a lot of nuance when dealing with this QBI deductions, and the great thing is the computer, calculates and factors in all of these deductions. But again, you want to be able to explain it, because if the client has any questions, or maybe there's an opportunity for strategic tax planning, maybe they pay more in W-2 wages and things of that nature. So this creates a great opportunity to get the client, to fully understand the nuances behind the QBI deduction. All right, this brings us to the last question. Here it asks, what is Tristan's QBI deduction? Assume that Tristan can aggregate these businesses. Determine her QBI deduction if she decides to aggregate the business. So here it says Tristan, who is single, operates 3 sole proprietorships that generate the following information in 2024. None are specified businesses. So we have business A, QBI is 300,000, W-2 wages of 90,000. Business B, QBI, a loss of 135,000 and W-2 wages of 60,000. And business C, QBI of 150,000, 0 W-2 wages, 0 capital investment. So it says Tristan chooses not to aggregate the business. She also earns 150,000 of wages from an unrelated business, and her modified taxable income before any QBI is 380,000. So because Tristan's taxable income is above the threshold amount, we see here modified taxable income is 380,000. This is well above the 191,950 limitation. So therefore, we need to factor in the W-2 wages limit. There's no capital investment, but the W-2 wages limit is factored in. So based on this, and we'll have separate ones for each question. All right, so based on this information, 20% of the QBI. And if we look at the problem, we see that, business B has a loss. So it's not much that can be done here. So here we see the 300,000. And let's start off with an individual. So for business A, we have 40% or 50% rather of the W-2 wages. The W-2 wages are 90,000. We multiply it by 50, which would give us 45,000. And then we factor in the QBI. So in order for us to calculate the QBI, the adjusted QBI would be as follows: 300,000 minus the W-2 wages of 90,000. So this is one of the other complexities as it relates to the QBI deduction, because in the other examples we see that there was only one business, and in this example there's more than one business. So we need to factor in how the other businesses are going to impact. So if the net amount of all positive and negative QBI is a loss, then there's no section 199A. But in such case, if we net all the positive and negative, net all of them and they are positive. So here we see 300,000 plus 130 or minus 135,000 plus 150,000. So you see that we have, a positive amount. So therefore, we need to factor in the impact. So we need to adjust this QBI. I'm actually going to create another sheet. All right, so we have business A, B, C. We need to factor in our adjusted QBI. We have our W-2 wages, and we have our capital investment. So I'll make another one, original QBI. All right, so our adjusted QBI in this case is a 300,000 minus the W-2 wages, which gives us 210,000. And again, under this regulation, Tristan has to allocate business B's negative QBI to both business A and business C in proportion to their positive QBI. So business A has 300,000 and business C has 150,000. So based on that information, the negative QBI from business B is apportioned 66% to business A and 33% to business A. So when we're deducting this 90,000, it's not just the 90,000 in wages. It's essentially, so we'll do it this way. Business A we have business B. So we have business income, total income. So for business A, the income is 300,000 and the total income is from business A and business C, which is 300,000 plus 150,000. So therefore, the proportion is as follows: 300,000 divided by 450, which gives us the 6.667. So loss allocation percentage. And then for business C, the business income is 150,000 and the total income is the same, 300,000 from business A plus 150,000 from business C. So therefore, the last loss allocation percentage for business C is 33%. All right, so we now need to factor in allocating the loss. So the loss is 135,000 multiplied, and that gives us the 90,000. And for business C, the loss allocated is the 45,000. So that is why the adjusted QBI, as we see here, is the original QBI minus the loss reduction of 90,000. There's no adjusted QBI because there's a loss. And for business C, it's the 150,000 minus the 45,000 as we calculated. So the adjusted QBI in this example is 105. Fix this up a bit. Right? And again, this is how we get the adjusted QBI. I'll probably write underneath it, original QBI minus the loss reduction. All right. So based on this information, we get the 105, and then now we can actually factor in what the QBI is going to be. So we have business ABC, we have QBI, adjusted QBI, times the 20%. And then from there, we factor in the W-2 wages times 50%. And then from there, we take the lesser of the two. All right, so just trying to fix this up as we go along. All right, so the adjusted QBI, as we calculated up above, is 210,000. We multiply it by 20%, that gives us 21,000. For B, the adjusted QBI is 0. For C, the adjusted QBI is 105,000 multiplied by 20%, and that gives us 21,000. And now we compare these. What's 50% of the W-2 wages? 90,000 multiplied by 50 gives us 45. W-2 wages for business B multiplied by 50%. W-2 wages is 50%. And 50% of 0 is 0. So now we compare the two. What is the lesser of the two? For business A, 42,000 versus 45,000. 42,000 is the lesser of the two. For business A, 0 versus 30,000. 0 is the lesser of the two. And the same thing applies for business C, 21,000 versus 0. So therefore, the deduction for the QBI deduction is 42,000. Now it's asking, assume that Tristan wants to aggregate the businesses, right? So in such case, none of the businesses own qualified property. So there's nothing here in the problem that lets us know that the business owns any qualified property. So as a result, only the W-2 wages limitation applies. And Tristan's qualified combined income would essentially be 63,000. And how we calculate that? Calculated as follows. 300,000 minus 135,000 plus 150,000, that gives us 315. If we multiply it by 20%, that gives us 63,000, or we would compare it to 50% of the W-2 wages. So the W-2 wages are 90,000 plus 60,000, which gives us 150. So therefore, we're comparing the 63,000 to the 75,000. So if Tristan decides to aggregate the business in such case, the QBI deduction would be 63,000, which is the total QBI between businesses A, B, and C, multiplied by 20% versus 50% of the W-2 wages. All right. So I know there was a lot to cover in this problem. Hopefully you gain a better understanding of the qualified business income deduction. Again, once you input this information into the tax software, it does all of the calculations, but you want to be able to understand the nuances behind the qualified business income deduction in case the client has any questions.